Welcome to Fasken's 14th consecutive mining series. My name is Michael Bourassa. I'm part of the Global Mining Group, and I'm based here in Toronto. Today's webinar, Canadian Clean Energy Tax Incentives, Where Are We Now?, is the first in our series of 14 seminars that we're holding this year. A calendar of all of our PDAC events can be found underneath the video window. And also, please refer to the slide on your screen for some housekeeping items. Now I'm going to turn it over to my colleague, Lori Bokenfohr, our first speaker today.
Thank you very much, Michael. And thank you all for joining us today. We are here to summarize for you, or depending on how closely you've been watching the story, to update you on a number of tax incentives introduced or to be introduced by the Canadian government in connection with the energy transition that has been planned and promised. We are very excited to tell this story because as tax practitioners, when it comes to legislation and new legislation in particular, we don't often get to tell a good story. So I'll start out with some introductions. We have a multidisciplinary group today. So my name is Lori Bokenfohr. I am a partner in the Calgary office. My practice is largely focused on corporate tax in the context of business transactions and reorganizations. I also deal with structuring of new businesses and ventures, including between taxable and non-taxable entities, such as Indigenous groups, and planning involving partnerships and joint ventures and trusts. So our friends at Ernst & Young, Dharmesh Gandhi, who's a partner of the SR&ED Incentives and Capital Investments Program at EY Canada. Dharmesh leads EY's Central Canada Business Tax Incentives practice, and he has 2 decades of experience assisting companies across Canada to obtain government grants and tax incentives. And he has particular specialization in the SR&ED program, the Scientific Research and Experimental Development Program. His clients are across multiple industries and often in growth markets. Dharmesh has an engineering physics degree and an MBA. Also from EY, Martin McLaughlin, who's a partner in the Incentives and Capital Markets Investments program at EY Canada. Martin is the national leader of EY's Canadian Capital Asset Review and Asset-Based Tax Credits practice. He also has two decades of experience helping both public and private sector companies access incentive opportunities and cash tax savings through accelerated deduction of expenditures and tax credits. He works closely with his clients at all stages of their businesses, including funding, growth, and transformation. Martin has a science and economics background and a CFA designation. Moving to Fasken, Alex Pankratz, who is our organizer for today, is a Toronto tax partner. His practice focus is tax planning for multinationals with operations in Canada, including in the context of mergers and acquisitions, reorganizations, and financings. His clients operate in a range of industries, from infrastructure and resources to the digital economy. He also assists clients in dealing with the Canada Revenue Agency in audits, appeals, rulings requests, waivers, and voluntary disclosures. Alex is a frequent speaker on international tax matters, and he's both a chartered professional accountant and a lawyer. And lastly, Ryan Rabinovitch. He is the co-leader of Fasken's Montreal tax group and a partner in our Montreal office. Ryan's practice deals with all aspects of tax law with a particular focus on planning. Ryan has represented many, if not most, of the major Canadian and non-Canadian developers of renewable energy projects. He has also presented at the annual Canadian Wind Energy Association regarding the tax aspects of structuring renewable energy projects. Ryan has also held a variety of positions in the legal profession, including working as a comparative law clerk for Aaron Barak of the Supreme Court of Israel and as a law clerk for the Honorable Louise Arbour of the Supreme Court of Canada. Now, before we get into the tax details, it might be helpful to step back, zoom out a bit, and provide some context. So Canada is promising a very large-scale energy transition. If it's successful, it will change not just the way we move around, but the way we build and heat our buildings, the way we produce the goods that we need, and the almost every aspect of industry, from steel making to fertilizer production. It will effectively rewire our economy. So when we think about something of this scale and ambition, a precedent in our history might be the construction of the Canadian Pacific Railway in 1881. So at that time, the federal government decided that construction of the railroad was necessary to preserve good faith in government. But the federal government also recognized that it didn't have the capability, the tools, the funding to get the job done itself. So it outsourced that to a private company, and it provided support mainly in the form of land grants and funding. So just like in the 1800s, today, the federal government is recognizing that it can't deliver the energy transition on its own. It lacks the know-how, the funding, the organizational infrastructure for anything that's on this large a scale. In terms of funding, by some estimates, Canada will require $115 billion of annual targeted investment in capital to get this done. That's an estimate that's provided by the Sustainable Finance Action Council. They are working towards enhanced climate-related disclosures. There are many estimates out there. Obviously, the government can't raise that tax revenue. If we look at what neighboring countries are doing, most notably the US, introduced the Inflation Reduction Act. It's a bit ahead of us. That the IRA includes a number of tax incentives that have already apparently attracted billions in investment and led to some significant transactions. So, for example, last year, there was the sale of the Squamish, BC-based company Carbon Engineering to Occidental Petroleum Corporation for $1.1 billion. So, Canada needs to do something parallel in order to ensure that our industries stay competitive, to encourage companies to both design and adopt new technologies, to unlock investments, and to create jobs. So, starting in 2021, the federal government announced a number of incentives, and these are multifaceted, as you'll see on this slide. So some of them are direct funding, for example, through the Strategic Innovation Fund or the Canada Growth Fund. Then there's a combination of carrots and sticks. So in terms of sticks, there's a regulatory framework, for example, the clean electricity regulations and the clean fuels regulations. When we talk about carrots, there are financial instruments such as contracts for difference that would backstop the price of, for example, carbon or hydrogen to de-risk very large-scale projects and provide some certainty. So an example of this is in December, the Canada Growth Fund made an investment in Calgary-based Entropy Inc., which is a company that designs carbon capture and sequestration programs. And it also included a fixed price carbon credit purchase agreement. So that's a financial instrument. And then there is strategic financing programs where traditional lending might be too expensive. So that's the backdrop, but what we're going to focus on is tax incentives. And these can be a very effective way to stimulate investment. And the main focus today is the 5 categories of refundable investment tax credits that are partially on track to becoming law. There's draft legislation for 4 out of the 5 of them. And Bill C-59 in particular, which is a larger budget implementation bill, contains 2 of them, and it's at the second reading stage of the House of Commons now. So these are refundable tax credits, which means that even if the tax payable is 0, they will result in a refund or a check from the Receiver General of Canada. They are extremely generous, unprecedented, in fact, and there is no cap on them. They operate as entitlement programs, so a company that qualifies is entitled to the tax credits. So we are also going to, or I guess Dharmesh is going to talk about a tax rate reduction that has been in place since 2021 that reduces the tax rate on manufacturing of certain equipment, because there have been proposals to enhance these in the fall economic statement. So we're going to move on now, but I will say that if you have questions, please insert them in the Have a Question box, and Alex will address those at the end. Thank you very much. We can move on to the next.
Thank you, Laurie. As mentioned, these tax credits have quite a bit of complexity to them. Hence, a collaborative relationship is needed between law firms and accounting firms and other providers in order to be able to maximize the credits. And that's pretty much why EY and Fasken are presenting here today. In terms of what accounting firms bring to the table, firms like EY, many of these credits are based on CCA classes. So it's critically important that companies segregate the core assets, but also the supplemental assets, so the mechanical, electrical, and structural components that go into the capital, so that a percentage of refundable credit can be applied to that. So that's what we refer to as cost segregation. It's something that our group is really focused on. One of the other considerations for companies is stacking. As these credits become so important to the rate of return that you're going to get from projects, ensuring that you've considered these green incentives along with discretionary incentives and other considerations such as carbon pricing, and making sure that they're stacked and layered properly to maximize the benefit for your projects. Lastly, and we actually saw an example of this already last week, is that many firms are actually building in these credits into their models already, even though the legislation isn't fully developed and completed. So making sure that the modeling is accurate and that the actual internal rate of return that's being calculated is actually going to meet expectations. So from an accounting perspective, cost modeling, support with identifying the proper expenditures that would go into the credits, actually helping with the tax credit calculations, and then preparing the cost analysis and the overviews and all of the analysis that ties into it is how your accounting teams can help. Now, over to you.
So as Dharmesh was just saying, there really is a nice complementarity between Fasken and EY. And when we first discussed the possibility of partnering up, I don't think we expected it really to be such a hand-in-glove kind of fit, and it really is. Because essentially all the things that Fasken specializes in, the lawyers specialize in, are things that EY's team doesn't really do, and vice versa. All the things that we really need EY to do are things that we don't do. So our focus generally is on, well, I would say it's macro and micro, in the sense that we focus on structuring the projects. In that sense, it's macro, and on papering and implementing the structures from a legal standpoint. In that sense, micro. But when you structure at 30,000 feet, that's one thing. But of course, you need somebody to model it, as Dharmesh just said, and that's really where we sort of fade into EY, and so we really need to work as a team. So in terms of what we do, again, it's structuring, reorganizing to access particularly the new investment tax credit and other benefits, because the rules are quite complicated, and often your structure can make all of the difference in terms of just determining whether you get the credits as a preliminary matter, and then whether you get them at the maximum rate or not. Again, as I said before, we also do implementation and documentation of the relevant legal arrangements, par for the course for a law firm. And of course, we have very good relationships with the tax authorities. We can obtain rulings and technical interpretations. And probably more fundamentally at this stage of the game, we can also, we have the ear of the people at the Department of Finance who are in charge of essentially making these rules and tweaking them as they go, because each iteration of the rules has glitches and creates certain uncertainty. And so there's a back and forth between the tax community and the Department of Finance. So we're very well suited to help you make sure that your project qualifies or get things changed, provided that they're consistent with Canadian tax policy. But that's definitely something that we can assist with. We can provide legal opinions, of course, and help bolster what might otherwise be considered uncertain tax positions. And of course, unlike most other professions, the work that we do for you is privileged, which means that it can't be accessed by the Canada Revenue Agency or Revenue Quebec on audit.
I guess, what are these 5 investment tax credits? The 5 investment tax credits really are the backbone of the incentives that we're about to talk about today. Really cover a wide array of businesses. They cover a wide array of technologies, and they range anywhere between 15 and 60%, depending on the type of technology being implemented, the year that it's being implemented. They cover everything from the extraction of minerals that are critical for the manufacture of clean technologies, so covering lithium, cobalt, nickel, copper, rare earth, and graphite. They cover equipment used for the manufacture of clean technologies. They cover the electrification and bringing clean electricity across borders, provincial borders, that is. They cover clean hydrogen and carbon capture, utilization, and storage. So at this point in time, as Laurie mentioned at the outset, 4 of the 5 tax credits have legislation that has been drafted. Those 4 credits include the carbon capture, utilization, and storage investment tax credit, which is in second reading. They cover the clean technology investment tax credit, which again is in second reading. And then the most recent 2 where we received draft legislative proposals on, which would be the clean hydrogen and the clean technology manufacturing investment tax credits, which received an initial sort of draft legislation that was released towards the end of the year and had feedback that was due on February 5th. So to the extent that businesses, and as I mentioned, are making investments into these types of clean technologies, so whether or not you're manufacturing, say, solar panels, electric vehicles, or you're extracting, processing, or recycling minerals for the manufacture of those vehicles, or you're just an adopter of the clean technologies. So think about businesses who are reducing their carbon footprint by either installing sort of solar backup battery storage at their facility, ground source or air source heat pumps. All of these types of technologies can in some way, shape, or form pick up these refundable investment tax credits. Now, one thing to note is that of the credits, 4 of them have labor conditions that are connected to the credits. Those labor conditions relate to prevailing wage requirements, as well as ensuring that there are certain apprenticeship requirements met. Those labor conditions are connected to the carbon capture, utilization, and storage investment tax credit, clean hydrogen, clean electricity, and clean technology investment tax credits. And if you don't meet those labor conditions, the credit itself is reduced by 10%. So as you get into these types of projects, I think as we work through these slides over the next little while, you'll notice that there's a recurring theme around ensuring that you're picking up, the right technology, picking up the right equipment, all the costs that are eligible, and ensuring that you're meeting the labor conditions, because these can have a significant impact on the credit that you're picking up as you move forward. So planning in advance is going to be extremely important. Over to you, Alex.
Great. Thanks, Martin. So as Martin said, there's 5 investment tax credits that are on offer here, 4 of which we have legislation for, 1 we don't quite yet. And so what I want to do is take a couple of minutes and talk about the clean technology ITC, which is just one of the 5. And so in the government documents, the purpose of this ITC is to encourage the investment of capital in the adoption and operation of clean technology property in Canada. So but this is sort of the first one, and this is the one that people are aware of to the most extent. Who is eligible? And so there's been a bit of a change in that over the different drafts of this legislation, but it's available to taxable Canadian corporations and to partnerships that include taxable Canadian corporations, and also, and this is the new addition, mutual fund trusts that are REITs. And so if you're going to use a partnership, so it's available to taxable Canadian corporations, but also partnerships that have taxable Canadian corporations as their partners. you got to be aware, and I know that Ryan's going to deal with an example at the end, dealing with how you're restricted in taking these ITCs to the extent of your at-risk amount. And there's also a rule that says your allocation must be reasonable as between the partners. For example, maybe you would have taxable Canadian corporations and others that aren't eligible for the ITC. How does one go about allocating? And I think Ryan's going to deal with that in the case study. So what is the tax credit? This is the 30% refundable. And as Laurie said, refundable means reduces your tax otherwise payable. And if you don't have tax otherwise payable or it exceeds it, you're going to get a check. So that's the refundable part. This ITC is available for investments that are acquired and available for use on or after March 28th, 23, which is last year's budget date, until December 31st, 2033. That's at the 30% rate. Then it's going to reduce in 2034 by half to 15%. And then for 2034 and after, it's going to be no tax credit. So we've got that interesting situation where we don't have law, but yet this applies to property that's been purchased all the way back to March of last year. So we're kind of operating a little bit blind here. And Martin referred to the labor requirements. I said it was 30% and then 15%. But it's actually only going to be 10% less than that. So 20 and 5 if you don't meet the labor requirements. And so what are they? There's two. And as Martin was saying, there's the prevailing wage requirement and then also the apprenticeship requirement. The prevailing wage requirement means that you're covered workers. And a covered worker is basically a person that's involved in the installation of the clean technology property and has duties that are primarily manual or physical in nature. And so those covered workers need to be paid in accordance with a collective agreement, or if there is no collective agreement, in similar wage to those that would, to the remuneration that would be earned by those who would be under a collective arrangement. So that's the prevailing wage requirement. The other one is the apprenticeship requirement, and that is that 10% of the labor that's going to be performed in what they call red seal trades must be performed by apprentices. So if you meet those requirements, you get the full. If you don't, then you're reduced by 10 percentage points. So 30% becomes 20%. So now that's when and all, but what is the type of property that's eligible? And here's a big laundry list. And so it's basically what's on this slide. And so I'll just go through it. The property that's eligible is equipment used to generate electricity from solar, wind, and water energy, electricity storage equipment that does not use any fossil fuel in its operation, active solar heating equipment, air source heat pumps and ground source heat pumps, non-road zero emission electric and hydrogen powered vehicles and related charging and refueling equipment used exclusively for the purpose of generating electrical energy and or heat energy solely from geothermal energy, equipment used to generate heat or electricity from concentrated sunlight, and finally, equipment that is used to generate electrical energy and or heat energy from nuclear fusion. So those are the types of property, but then overlaying that is a few other requirements. So there's three. The first one is that it has to be situated in Canada and for use exclusively in Canada. The second one is that the property must be new when it's acquired by the taxpayer, so no used equipment. And the last one is it also applies to lessors. But if it's going to be leased by the taxpayer, the lessee must generally be a taxable Canadian corporation, kind of people that would be involved in getting the ITC if they bought it directly, or a partnership, all the members of which are taxable Canadian corporations. And finally, in the context of that leasing, the lessor must be in basically the business of leasing or the business of selling or servicing that type of property or the business of money lending or any combination of them. So that's the credit. However, you can be asked to disgorge the credit. It's sort of the recapture rules. And it is if within 10 calendar years of the acquisition of the property, you do one of three things, that is convert the property into a non-clean technology use, you export the property from Canada, or you dispose of the property. And with respect to dispositions of the property, there are rollover rules that won't make you disgorge the ITC if it's to a related taxable Canadian corporation. So that is the clean technology ITC and what I wanted to say about it. So over to you, Lori, for the CCUS.
Thanks, Alex. So this is the credit number 2, the carbon capture, utilization, and storage, or CCUS tax credit. So similar situation here where it's looking backwards in time, starting in 2021 up to 2040 with a rate reduction in halfway through that in 2031. So this credit, it applies to the capital expenses that are qualified CCUS expenditures. So those are expenditures that are expected to support capture of carbon, and they must be used for a qualified CCUS project. So that is a project that is either capturing, transporting, using, or storing carbon. There are a couple of new CCA or capital cost allowance classes that are proposed in support of this credit. It's new class 57 and class 58. They are very prescriptive. It's a long list, so I won't try to start to recite them, but in sum, Class 57 is equipment for capturing carbon dioxide that would otherwise be released into the atmosphere or that compresses captured carbon for transportation. So that's Class 57. Class 58 is equipment that uses captured carbon in industrial production, including for enhanced oil recovery and production of concrete. In terms of the storage element, the equipment must be used for storage in dedicated geological storage. So right now, that means the 3 prairie provinces west of Manitoba, so not including Manitoba, or jurisdictions designated by the minister, and that could include inside or outside Canada in the US. And in addition to that, Class 57 and Class 58 equipment, anything that is functionally integrated into a system with that equipment, for example, that generates heat or electricity, that treats or recirculates water, that supports fuel supply or electricity, venting, cooling, waste management, and safety and monitoring equipment are included. This credit requires a project evaluation at the outset and ongoing reporting. So that covers that one. Back to you, Alex.
Thanks, Lori. So the Clean Technology Manufacturing Investment Tax Credit, even though it sounds similar to the Clean Technology Investment Tax Credit, is very different. It is a refundable investment tax credit up to 30% of the capital cost of eligible property associated with eligible activities. And we're going to talk a little bit about what those activities and those and kind of what that property is. But so eligible activities include clean technology manufacturing and processing, as well as critical mineral extraction and processing. Currently, critical minerals would consider things such as lithium, graphite, nickel, cobalt, copper, and rare earth elements. Eligible properties generally include machinery and equipment and certain industrial vehicles used in manufacturing processing of critical minerals, as well as the related control systems. Obviously, the ASA rules apply to all of this, so they must be substantially used for each one of these activities, and the activities can be fairly broad. You know, they can be related to manufacturing of zero emission vehicles. So a lot of the new automotive plants that are coming up, as well as conversion of on-road vehicles, those do need to be new vehicles that are being converted, renewable energy equipment, so solar, wind, water, and geothermal. So a lot of the things that were mentioned actually for the clean technology, when they're actually used, so the manufacturer of those, if that's being done in Canada, can actually claim. And for a lot of these companies, if you're manufacturing and then also selling these components, it's a double whammy, right? Because you yourself can claim the credit when you're actually manufacturing it, in addition to the people and the folks buying the actual equipment can also obtain a credit. So there's a double benefit there. Electrical storage equipment, usually what comes to mind there is, the creation of car batteries is a great one. There's a lot of car battery facilities that are being built across Canada. So a lot of those firms should be able to take advantage of this, as well as things related to heat pump systems. And additional items would apply as well, and it can be fairly broad. And so it can behooves companies to look into if their actual creation might qualify. Equipment that is eligible must be available for use on or after January 1st, 2024. And there is a phase out between 2023 and 2032 and 2034. There was some consultation done in December, and we got draft legislation proposals out there. But this one is well behind the 3 other credits that are being discussed, but it is progressing. So we hope to have some resolution on this over the next couple of months. I think it's back over to you, Laurie, for clean hydrogen.
Thanks, Dharmesh. So this investment tax credit has a stated purpose in the legislation. It is to encourage investment in the production of clean hydrogen and clean ammonia in Canada. The credit is a specified percentage of the capital cost of clean hydrogen property that is acquired and available for use in connection with a clean hydrogen project. The rate varies depending on the carbon intensity in the production process. So the lower the carbon intensity, the higher the credit. So clean hydrogen property, what is that? So that is, again, property situated in Canada. There is an amendment to Class 43.1 that currently includes equipment associated with electricity and heat generation. And it is otherwise property that's used all or substantially all to produce hydrogen through natural gas reforming, for example, pre-reformers, autothermal reformers, steam methane reformers, syngas coolers, shift reactors, purification equipment, fire heaters, water treatment and conditioning equipment, oxygen production equipment, and methanizers. So that's not a complete list, that's some of them. And also it includes equipment used in hydrogen compression and storage and clean ammonia equipment. Also included is certain dual use equipment, so dual use between electricity and heat and between hydrogen and ammonia. And once again, it includes anything physically and functionally integrated within that system or supporting it, including feed supply, cooling, waste management, and safety and monitoring equipment. So this one starts as a budget day 2023, March 28th, and it will go to 2034. This one also requires the filing and ministerial approval of an initial clean hydrogen plan. So that must be supported by a report by a qualified engineering firm. And it also requires annual carbon intensity reporting. So that covers that one. Thank you.
Okay, so back to me. This is the 5th of 5. This is the Clean Electricity Investment Tax Credit. This is the one that we know the least about because it has no draft legislation yet. We've been told by the Department of Finance that we should have details about the design and implementation in early 2024. So that means now, so soon. Who's it available for? It's available for taxable and non-taxable entities. So remember before we were talking about it had to be taxable Canadian corporations or partnerships of the same. And now it's available for more taxable and non-taxable. So it'd be for crown corporations, publicly owned utilities, corporations owned by Indigenous groups, pension funds. So a much wider group that's available, that this would be available for. So what are the types of property that it's a 15% tax credit. And again, the labor requirement, if you don't meet it, it's reduced by 10%. So you're down to 5%. But what are the types of property? And this is what we do know so far, is that the investments will be for, I got a list of 4 here, not a complete list. Non-emitting electricity generating systems from wind, concentrated solar photovoltaic, hydro, wave, tidal, and nuclear. So that's all the non-emitting electricity generating systems. Certain abated natural gas-fired electricity generation. Third, stationary electricity storage systems that do not use fossil fuels in their operation. And the last one is equipment for the transmission of electricity between provinces and territories. And so as for timing, we know that we don't have draft legislation, but we do know that it will be available as of the day of the 2024 budget, so in a few months, that it's delivered, for projects that didn't begin construction before March 28th, 2023, which is the 23 budget date. And this will be phased out, not available after 2034. So Dharmesh, I think it's back to you.
Just before we move on, just note that this clean electricity tax credit, it's indicated on the slide, is available to taxable and non-taxable entities. And that's going to be relevant later because it's sort of the equivalent in some way of the clean technology investment tax credit, which is the first credit we looked at, except that it's available to tax-exempt investors, and that includes First Nation groups and municipalities. And the key difference being that the first credit that we began with is a 30% credit, and this clean electricity credit is a 15% credit. So it's a bit of a lesser credit, and that we're going to come back to that later.
Terrific.
Great. Just in addition to those 5 credits, we thought it was important to mention the rate reduction for zero emission technology manufacturing. This is a kind of a bonus, I would say. So it's a temporary reduction in the federal income tax rate on eligible income from zero emission technologies, manufacturing and processing. So as you will note, the eligible activities are similar to those outlined for the clean technology manufacturing ITC. So once again, it includes zero emission vehicles, including conversions of on-road, renewable energy, both for solar, wind, water, and geothermal, electrical energy storage equipment, such as grid scale storage or ancillary storages, such as batteries, manufacturing of equipment for air and ground sources, for heat pumps. And in general, the federal income tax rate is reduced from 15 to 7.5%, and for CCPCs, that you get the additional benefit of the from 9 to 4.5%. It is based on the ratios of eligible capital and labor used for the activities, and the rate reduction is available from 2022 to 2028 with a proposal to extend to 2031. With that, I'm going to pass it over to Martin for the first of our 4 case studies.
Thanks, Dharmesh. So how does this really impact businesses on a scale? So, the credits we've kind of covered include, as available to all types of businesses. One thing I do want to mention is that even for the credits where we're thinking about the clean technology investment tax credit and the clean hydrogen investment tax credit, where you're theoretically able to claim this as of March 28th, 2023, we still have yet to see any prescribed forms for that. So that is something that needs to be released. And so the hope is that we will start to see prescribed forms in the not too distant future. But the real question is, how does this impact businesses? And so over the next few slides, we've got a couple of concrete examples just to kind of give you a flavor for the examples of types of projects or businesses that might qualify for investment tax credits of any sort. and in particular, obviously, these investment tax credits. And the reason why we've selected different industries is just to show how broad these investment tax credits are. So the first investment tax credit, the first case study that we're going to talk about is a beverage manufacturer. So let's imagine a large multinational beverage manufacturer with locations throughout Canada. This manufacturer obviously isn't going to be eligible for the Clean Technology Manufacturing Investment Tax Credit, but let's say they're able to, pick up credits in the Atlantic provinces, in Manitoba, Saskatchewan, that are related to manufacturing and processing. But they also want to look at opportunities to reduce their carbon footprint. Their sustainability initiatives include things like the acquisition of new equipment, expansions and retrofits to their existing manufacturing operations in order to reduce their carbon footprint. They look at construction of new warehouses. They have sustainability initiatives, which can cover a wide array of opportunities. Now, let's say this particular business is also looking to electrify their fleet. Now, when Dharmesh mentioned earlier on about the Clean Technology Manufacturing Investment Tax Credit, and Alex was talking about the Clean Technology ITC, Alex mentioned, and so did Dharmesh, about certain zero emission vehicles. Now, this particular manufacturer who has electrifying their fleet, they're not going to be able to pick up the investment tax credit for clean technologies because it's only for non-road vehicles. However, if we're looking at, other types of investments, like investments into geothermal, solar panels, backup battery storage, and heat pumps, these types of activities and these types of costs are going to potentially pick up the clean technology investment tax credit. So in addition to picking up the clean technology investment tax credit, as Dharmesh mentioned, most of these costs, these equipment costs, fall into certain categories for capital cost allowance purposes. They're going to get both accelerated depreciation on the investment tax credit on the equipment that they're using or acquiring that qualifies for the investment tax credit. They're also going to pick up the
You're back.
Oh, that was quick. Okay, sorry about that. So I think I might have left off when we were talking about. All right, let's take a step back. So this client or this business is investing into equipment that would pick up the 30% refundable investment tax credit, but they also are able to pick up accelerated capital cost allowance. So let's imagine a scenario where they spend $1 million on a piece of equipment that is eligible for both the accelerated depreciation and the 30% refundable investment tax credit. The way the credits are structured is that you would have to remove the credit as government assistance from the cost of your capital in order to ensure to reduce the cost of capital and the undepreciated capital cost of that equipment. So on your $1 million, if you pick up a 30% refundable investment tax credit, you're eligible to depreciate $700,000 as accelerated depreciation. But keep in mind, this business is potentially looking at sort of a wide array of opportunities. So to the extent that they would receive any other government assistance related to these types of investments, then they would have to also net that from the capital cost allowance on which they calculate their investment tax credit. All I want to mention here is that a detailed review, and by going through the capital cost allowance classifications, understanding the costs like electrical, mechanical, structural, that would be there in support of their geothermal, their solar panels, their heat pumps, those costs can help to increase the investment tax credit and also attract accelerated capital cost allowance. Now, to the extent that this business is looking on a forward basis, they should look at considering those labor conditions because they're not eligible for the Clean Technology Manufacturing Investment Tax Credit, but they're going to pick up the Clean Technology Investment Tax Credit. So if you recall, as we talked at the outset, the Clean Tech Investment Tax Credit has those labor conditions that are connected to it. So to the extent that they're going to be installing the geothermal, because the heat pumps are actually excluded, or to the extent that they're installing solar panels or backup battery storage, they should ensure that the people who are covered workers on the project are meeting those apprenticeship requirements as well as the prevailing wage conditions that are set out. So again, just an example of a business that is not necessarily someone that you would think would be eligible for these investment tax credits. However, to the extent that they're lowering their emissions profile, they could pick up the ITCs. That'll turn it over to Dharmesh for our second example.
Thanks, Martin. My example is going to cover off the credit as well as the zero emission technology manufacturing rate reduction that I discussed. And what it really seeks to do is talk about how site selection is being impacted by these credits. So the specific example is an automotive parts and EV battery technology manufacturer. They're a multinational, and they were evaluating where best to locate their plants, as well as figure out where to add additional lines. So part of that discussion involved, okay, well, if we're undertaking multiple projects in various plants across Canada, both to accommodate e-mobility as well as battery technology, what should we be thinking about? And kind of what those expansions included was, facilities, including investments in geothermal and solar, installation of new manufacturing lines. As I'm sure many have seen, anytime that you are making a big change to your automotive-based platform, there are lots of changes that are required for the manufacturing line, so new lines were needed, as well as conversion of kind of existing operations to support e-mobility and kind of battery technology, which is very different than kind of ICE technology. So the approach that we took is that we started looking at all of the supporting documentation. It really did require a detailed review of capital expenditures, as well as the CCA classes, what the facility layouts were going to look like. We had to have a discussion with the key engineers and finance personnel to kind of identify what the classifications were going to be that would allow us to maximize the credits if they were going to claim them. And some of the opportunities that were identified, very similar to kind of the previous discussion that Martin just had, was accelerated capital cost allowance and tax deductions are always a part of the conversation, because the first step is making sure that the assets are allocated properly and in the right classes, so that we can maximize the credit as well as gain the benefits of a kind of accelerated depreciation. Looking at the investment tax credits available for manufacturers, both provincially and federally, not just the green incentives. So going back to my original conversation around discretionary credits and green credits and all of these, looking at credits such as SIF and the larger credits, keeping in mind that there are some hiccups with when double claiming, because if you're in certain situations for some of these credits, if you're claiming for SIF, you actually need to back out of being able to claim for the other credits, as well as clean technology and kind of the green investment tax credits. What we ended up finding, and kind of the discussion where it ended up reaching, was, they were obviously eligible for the clean technology manufacturing investment tax credit, specifically because of the manufacturing of electrical vehicle batteries. The zero emission technology rate reduction did apply to them, related to capital and labor. And the clean technology investment tax credits for investments in geothermal and solar panels were also available to them. So overall, this led to a big reduction in terms of the cost of the actual project itself, while also making Canada the right choice to invest in terms of this project. I will pass it back over to Martin for our third case study.
Thanks, Dharmesh. So in our third case study, we're going to look at sort of the interaction between two investment tax credits that we've covered for the clean technology, or so the clean economy ITCs that we were speaking about earlier. These two investment tax credits that sort of interact in this case are the clean technology and the clean technology manufacturing investment tax credit. Now, one thing I do want to mention with all of these credits, with the exception of the carbon capture utilization and storage tax credit, is that the way that they're currently, the draft legislation is written, is that they are available to be claimed once the asset is available for use. So when you're setting out in this example to look at this project, think about what credits are available and how they interact, because if you're looking at claiming two of these investment tax credits to the extent that the clean technology and the clean technology manufacturing investment tax credit, a piece of equipment would qualify for both, and they will in this particular example, potentially. You can only pick up one of the investment tax credits. You can't claim a 30% refundable investment tax credit on a piece of equipment under the clean technology ITC and a 30% refundable investment tax credit also under the clean technology manufacturing ITC. So that's where it becomes imperative to sort of look at your project and understand whether or not I should be claiming the clean technology manufacturing or the clean technology ITC, because one has labor conditions attached to it and the other does not. Okay, so in this particular example, we have a mining business that is a corporation that will be mining and processing minerals that are critical for the manufacture of zero emission technologies. So this business in this example would be claiming investment tax credits related to zero emission mining equipment. They're purchasing equipment for the extraction, processing of critical minerals for the manufacture of clean technologies. So if you recall, those critical minerals include lithium, cobalt, nickel, copper, rare earth, and to the extent, nickel, copper, rare earth, and graphite. And in this particular example, this business is acquiring equipment that's used in qualifying mineral activities, so extracting and processing, and they're also acquiring non-road zero emission vehicles, solar panels, that are used at remote locations, as well as backup battery storage for those solar panels at the remote locations. So by looking at a detailed review of supporting documentation, going through their projects and looking at sort of discussions and interviews with project personnel, we can also review sort of the legislation as it currently stands. We're able to identify costs that would fit into the capital cost allowance classes that are going to pick up the investment tax credits, either under the clean technology investment tax credit or the clean technology manufacturing investment tax credit. So as I said, the opportunities available for the clean technology manufacturing investment tax credit would be to the extent that they are processing or extracting minerals that are where the equipment is used all or substantially all, as Dharmesh mentioned, for the extraction or processing of those critical minerals. We could potentially pick up the 30% clean technology manufacturing investment tax credit. For equipment where they have non-road zero emission vehicles and the related charging or refueling equipment, this could be eligible for both the clean technology investment tax credit and potentially the clean technology manufacturing investment tax credit. So that's where it becomes imperative to say, what is the best decision for my business under this particular situation? Now, the zero emission vehicles are actually similar to the heat pumps, are excluded as of right now from the labor conditions, but it is something to consider because, you know, to the extent that maybe solar panels might be used as part of your clean technology manufacturing operations versus the clean technology investment tax credit, the solar panels or the backup battery storage would be required to meet those labor conditions from a covered workers perspective. And so, you know, looking at your project as in a holistic sense, breaking it up, identifying which costs would be eligible under which capital cost allowance class, which investment tax credit is going to be key as businesses start to take on these credits. So once again, just a reminder, the credits will be claimed when the asset is available for use. So, you know, along with the year, the tax return for the year in which the fixed assets become available for use is the year that we claim the credits. So with that, I'll turn it over to Ryan to talk a little bit about our next case study.
Okay, so in the next case study, I'm going to talk about some of the issues that come up in structuring renewable energy projects to maximize the ability to access some of these credits and some of the glitches that we mentioned before in the credits and how they interact with each other. And the goal here is not to make you all tax structuring experts, but rather to show you just how much uncertainty and complexity has been generated by them and maybe start you thinking about some of the issues that'll come up if you try and access them in the context of a renewable energy project. So this case study involves a limited partnership, a joint venture, if you will, between a renewable energy developer and either a First Nation or a municipality or some other tax-exempt investor. As you probably know, more often than not, it's First Nations and municipalities that partner up with developers in order to generate these projects. And they're encouraged to do that by the rules that govern the various calls for tenders in each province that govern renewable energy projects. So in this example, it's 50-50, a taxable developer and a tax-exempt First Nation or municipality. So we're each putting in $125 million of equity into the project. So that's 250 in total. And then the limited partnership that's receiving the equity from the developer and the First Nation or the municipality will then go borrow from the bank a further $750 million to bring it to a total of $1 billion of funds there. So a fairly big project with 25% being funded by equity and 75% being funded by debt. So 125 plus 125 plus 750 is $1 billion. And let's say that the full $1 billion is used to go out and buy eligible assets that are used to produce wind energy or solar energy. So the first kind of background point is you would think that given what we've told you until now about the clean technology investment tax credit, that there should be about $300 million worth of credit here, in the sense that 30% of $1 billion that's spent on eligible assets should give rise to the clean technology investment tax credit of $300 million. And you're going to see that that's actually not at all the case. And it's going to get less and less intuitive in this example. So the first thing to note is that these ITCs in the context of a partnership are not claimed by the partnership itself, but rather by the partners. So each partner claims its respective share of whatever credit has been earned, notionally speaking. And remember, as I said before, that the clean technology investment tax credit is only available to taxable investors, and the clean electricity investment tax credit, for which we don't really have much guidance, will be available to both taxable and non-taxable investors. So if you put those two together, what it means is that the developer can claim the 30% credit, but the First Nation or the municipality can only claim the 15% credit because it's tax exempt. So what does that mean in theory? So we were starting at 300 million, 30% of $1 billion when we began. So you can see that that's been shaved down, and now the developer should be entitled to about 150 million, which is 30% of its share of the expenses, 500 million. The developer gets the 30%. That's very nice. But now the First Nation and the municipality is only getting 75 million, which is 15% of its 500 million. And so we've lost 75 million right out of the gate, because the credit is taken at the partner level and not the partnership level. And so now it's not even going to be that, because you're going to see that there's going to be more problems. So under the initial version of the legislation that we got in the summer, they basically said that the partners, both partners, would only be able to claim the credit in respect of funds that were used to buy the eligible property that were sourced in equity and not in debt, which means that the developer could only, even though the developer's share of the total cost is 500 million and the First Nation and municipality share of the total cost is 500 million, only 125 million of each of those buckets came from each of their equity. And so the initial rule was you could only claim 30% of what you put in yourself as a partner, which meant that the developer would get 30% of 125 million and the First Nation would get 15% of 125 million. So we've gone at the developer now, we've gone from a credit of 150 million down to 37.5 million. So it's a pretty big disaster. You losing $112.5 million of credit. And a lot of taxpayers said to the government that this was totally unreasonable. And as you're going to see, it really arbitrarily penalized structures that were set up as limited partnerships, as opposed to structures that were set up as corporations and unincorporated joint ventures. And so the government released a new proposal in November that is better, but still not perfect. And the government said, okay, fine. We're still going to look at your equity, but we're going to limit your credit to 100% of your equity instead of 30% of your equity. And so they basically said, all right, taxable developer, your share of the total spend here is 500 million. So you can claim the lesser of 30% of 500 million, 150 million, or your equity, which is 125 million. And here, because equity is 125 million, the lesser of those two amounts is 125 million, and you end up still losing $25 million of credit because of this overriding 100% of equity limitation on the amount of credit that you can claim. And $25 million is not it's not a small amount, and can make all the difference in the context of these projects. So that's where we stand today. That first of all, you're not going to max out the credit because one of you is a tax exempt, and second, you have this overriding rule that limits the amount of your credit to 100% of your equity. So if the project is highly leveraged, you're not going to get the maximum credit for that reason too. It's kind of a double whammy. And as many of you will appreciate, the ability to access the maximum amount of credit influences your ability to propose if you're bidding. If you're bidding on one of these projects, it influences your ability to put in the most competitive bid. So the less credit you can get, the less easy it is for you to put in a competitive bid and win the project. The last rule that's really cast a shadow over all of this is an apportionment rule that was introduced in November, which suggests that we couldn't actually stream the credits in the manner that I just suggested, so that the developer takes the 30% credit and the municipality takes the 15% credit, because this rule suggests that each partner has to take a pro rata share of each credit that's claimed in respect to the partnership, meaning that if you want to take the 15% credit for half of the investment, then the developer has to take the 15% credit, half the 15% credit and half the 30% credit, and the municipality has to take half the 15% credit and can't claim the 30% credit, which is yet another shaving of the amount that's available here, because it means that the developer is effectively claiming the credit at a blended rate between 15 and 30, and the municipality is claiming the credit at a blended rate between 0 and 15. So all kinds of problems, and people, including us, have spoken to the Department of Finance and asked them to clarify this, because it's all of these rules keep shaving down the amount of credit that can be claimed. And I suppose I should have said in advance that the limited partnership structure was pretty much the basic Tax 101 structure that these projects were structured as up until these new rules came about. And the impact that the rules have in the partnership context are causing a whole rethinking of how these projects should be structured on a going forward basis, which is creating a lot of work for lawyers and accountants, and not sure it's the best use of taxpayers' money. So turning to what does that mean? Sort of how is this changing and how is structuring changing? There's kind of two obvious alternatives to a limited partnership structure. One is what we call a taxable corporation, and one is an unincorporated joint venture. So taxable corporation is the one on the left, and it basically means that it looks exactly like the limited partnership structure, except instead of investing in a limited partnership, the partners now invest in a taxable corporation, and the corporation goes out and spends the $1 billion. And because taxable corporations is not subject to any of the rules that I just mentioned, the idea is you get around most of these issues, but it's an imperfect answer for several reasons. First, on the bright side, the taxable corporation is eligible for the 30% credit on all of its spend. So that's good for everyone. That's good for the taxable developer, gets its full 150 million on its 500 million share of the cost. And now the tax exempt is getting 150 million on its 500 million share of the cost. So that's great. We've now, instead of having half of the spend generating a lower credit, everybody's generating a higher credit. But tax exempts tend not to like to invest in taxable corporate structure because they'd rather not pay tax indirectly. If a tax exempt invests in a taxable corporation, to the extent that the corporation eventually becomes taxable and has net income each year, it's going to be paying dividends to the tax exempt that are out of its after-tax profit. So the First Nation or the municipality is getting an after-tax return instead of a return that's not subject to any tax. Partnerships and unincorporated joint ventures are completely transparent for tax purposes, which means that under those structures, the income of the project just gets attributed to each partner, and each partner pays tax on it based on their status. And First Nations municipality status means they don't have to pay any. So there's a trade-off here, which is not ideal, that the First Nations and municipality is accessing a higher credit, and we're solving the limited partnership problems. But on the other hand, the First Nations and municipality is getting an after-tax return, and that has to be modeled out to make sure that it's not going to penalize the First Nation or the municipality before everybody says, okay, we can go forward with the structure and solve the quote-unquote problems that I just identified with limited partnership structures. Another issue with this structure is that it requires the taxable corporation to pay dividends, and generally in tax, the tax authorities have introduced a rule that makes it tough to pay dividends out of a corporation to another corporation without worrying about those dividends being recharacterized as a capital gain. And so this ought to be able to be done, but a lot of tax practitioners will pause before running headfirst into a structure that causes them to pay these dividends that might be recharacterized as capital gains. That means, in other words, the taxable corporation pays tax, and then the shareholders pay tax a second time when the funds are transferred out of the taxable corporation, which is generally seen as a problem from an income tax standpoint. The other solution, which is probably perfect from an income tax standpoint, but a bit of a nightmare for commercial lawyers and business people, and certainly banks, is the unincorporated joint venture. So why do I say that it's perfect? First, it's, again, not a limited partnership, so none of the problems that I mentioned before. And second, it's not a corporation, so none of the problems that I just mentioned right now on the left side of this slide. It doesn't pay any tax. So once again, everything is flow through. Everybody gets their pro rata share of the profit. Don't have to deal with any partnership problems. It's true that the municipality can only claim its pro rata share of the credit at the 15% rate because it's not eligible. The First Nation or the municipality can't claim the 30% credit, but it may be very happy to do that because it doesn't have to worry about getting an after-tax return. There's not this trade-off that we had to deal with in the previous taxable corporation scenario. So pretty good results from an income tax standpoint, but from a commercial standpoint, though this has been done in Canada quite a few times, a lot of people in the industry find it too heavy because it means that when you go to the bank, you don't have one borrower, you don't have a corporate borrower, you don't have a partnership borrower, you have everybody's a borrower, and all kinds of other issues. When you have an unincorporated joint venture where sort of everybody is involved in everything, and that could be seen as heavy and complicated. So again, the purpose of this case study is not to make you all experts in how to structure your project in order to maximize the credits, but it's just designed to show you the kind of complexity that the new rules have generated, and also how they're changing how we do our business, so to speak, vis-a-vis the way we've been doing it for the last decade or two.
Well, thanks a lot, Ryan. That's just great. When you were referring to the equity amount, that was a reference to the at-risk rules, right?
That's right. Yeah.
So if anybody has any questions that they'd like to ask, please put them in. We have a few, and so we'll start there. But if there's more, let us know. And so the first question we have, and anybody who wants to pick it up, please do. You mentioned that there's a tax credit, but what if no tax is to be paid and that a check will be sent? That's what we had said. And the question is, what about an outfit that's not generating any revenue in Canada yet? Will a check be sent to them to cover the portion of the capital cost? So anybody?
Yeah, so I mean, I can take that. So your question, you mentioned it's not generating revenue in Canada yet. So I'm not sure if that means it's carrying on business outside of Canada. If that's the case, then these tax credits would not be available. But if it is carrying on business in Canada and all the other requirements are met, I should say that the carbon capture, the CCUS does allow for geological storage potentially outside of Canada. But the way these work is that even if there's no tax payable for whatever reason, because of the way affairs have been organized, because of a very aggressive CapEx program, whatever it is, yes, when there's a refundable credit available, it results in a refund from the Receiver General of Canada. I hope I answered that question. Does anybody else want to add to that?
I'll add something quickly. I think the only thing I would add to that is to the extent that, again, looking at the available for use rules, the funds will come after the fact. So to the extent you would have to make that investment first. So if you're not a revenue generating corporation, even if you're a Canadian company and you haven't spent that money, then you're not entitled to claim the credit. So, let's say you're purchasing, again, a piece of equipment that would qualify under one of these investment tax credits, with the exception of the CCUS tax credit, which is claimed when the costs are incurred. The other ones would be claimed once that asset is available for use. So again, you need to have incurred those costs anyway in order to pick up the credit. That's all.
Terrific. Thanks, Martin and Lori. So second question. And this is interesting because I wrote something on this stuff back in December, and it was pretty long. And I got phone calls from just cold calls about it. And one of them was exactly this question. And so the question is, do you know if these credits are also for homeowners who install solar systems? So I said no, because doesn't sound to me like it's a taxable Canadian corporation or a REIT. And so I said no to that question. Now, that's not to say that the person who manufactures the solar system couldn't get maybe the manufacturing ITC, but that's a whole different kettle of fish. So has anybody got anything to add to that?
Yeah, I totally agree with that, Alex. And the other thing I was thinking when I saw that question is that all of the clean technology property is defined by reference to the depreciation classes in the Income Tax Act. And all of those classes are subject to this rule that you're only in the class if it's used for the purposes of producing income. So I think that's another reason. But I totally agree with your reason.
Right.
I think on top of that, you have that.
It's interesting. It's a recurring question. I think people want to cover the cost of putting their solar panels on their home. So I don't think we have any other questions. So I think maybe we've reached the end, folks. So I'm just going to sort of close around. So in closing, I'd like to thank you all for joining us today. And I'd like to especially thank my co-presenters for their excellent work today. And I will tell you that the next Fasken PDAC session will be taking place tomorrow, the 27th at 11 a.m. Toronto time. And it will be the Fraser Institute will share the results of their annual mining survey. And you can sign up for that or any of the upcoming webinars through the virtual calendar below or by visiting Fasken Institute section on fasken.com. So we hope that you found this presentation to be worthwhile and hope that you'll join us for some of the upcoming sessions. But for now, thank you all for attending our session. And that's all.